Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Overview of Investment Fundamentals. Investment fundamentals encompass a range of concepts and strategies essential for making informed financial decisions. These principles form the bedrock of strategic investment theories, which enable investors to effectively allocate resources and manage risk. A clear understanding of these fundamentals is crucial for anyone aiming to master strategic investment. At its core, investment is the act of allocating money in the expectation of some benefit in the future. This benefit is typically in the form of returns, which can be realized as income or capital gains. The first principle of investment is understanding the relationship between risk and return. According to modern portfolio theory, there is a direct correlation between the level of risk taken and the potential return. Higher potential returns are usually associated with higher levels of risk. For example, stocks generally offer higher returns compared to bonds but come with higher volatility. Diversification is another foundational principle in investment. It involves spreading investments across various assets to reduce risk. By diversifying, investors can mitigate the impact of poor performance in any single investment. This concept is supported by Markowitz's efficient frontier theory, which illustrates that a well-diversified portfolio can achieve the highest possible return for a given level of risk. An example of diversification is including a mix of stocks, bonds, real estate, and other asset classes in a portfolio. Asset allocation is a strategic approach that determines how an investor's portfolio is divided among different asset classes. The primary goal of asset allocation is to balance risk and reward according to an investor's risk tolerance, investment goals, and investment horizon. Research has shown that asset allocation is one of the most critical determinants of portfolio performance, often accounting for over 90% of the variability in returns. For instance, a young investor with a long-term horizon might have a higher allocation to equities, while a retiree might prefer a higher allocation to bonds. The time value of money is another crucial concept in investment. It posits that a sum of money has greater value today than the same sum in the future due to its potential earning capacity. This principle underpins various investment evaluation techniques such as net present value and internal rate of return. For example, if an investor expects to receive $1,000 1 year from now, the present value of that $1,000 today would be less, considering a discount rate that reflects the opportunity cost of capital. Market efficiency is a key theory in understanding how information affects asset prices. According to the efficient market hypothesis, asset prices fully reflect all available information at any given time. As a result, it is impossible to consistently achieve higher returns than the overall market through stock picking or market timing. This theory suggests that passive investment strategies, such as investing in index funds, are more effective for most investors. An example supporting EMH is the performance of actively managed mutual funds, which often fail to outperform their benchmark indices over the long term. Behavioral finance challenges the notion of market efficiency by examining how psychological factors influence investor behavior. It suggests that cognitive biases and emotions can lead to irrational financial decisions, resulting in market anomalies and inefficiencies. For example, the phenomenon of herding behavior, where investors follow the actions of others rather than relying on their own analysis, can lead to asset bubbles and market crashes. Understanding these behavioral biases can help investors make more rational decisions and avoid common pitfalls. Compounding is another fundamental concept in investment. It refers to the process where the value of an investment grows exponentially over time as earnings on an investment generate their own earnings. Albert Einstein famously referred to compounding as the eighth wonder of the world. For instance, An investment of $10,000 at an annual interest rate of 7% will grow to approximately $19,672 in 10 years, $38,697 in 20 years, and $76,120 in 30 years due to the power of compounding. Taxes and inflation are external factors that significantly impact investment returns. Taxes can erode a substantial portion of investment gains, making tax-efficient investing an important strategy. For example, utilizing tax-advantaged accounts such as IRAs and 401s can help minimize tax liability. Inflation, on the other hand, reduces the purchasing power of money over time. To preserve and grow wealth, investments must generate returns that outpace inflation. Historical data shows that equities have typically outpaced inflation over the long term, making them a preferred choice for growth-oriented investors. Fixed income securities, such as bonds, are a critical component of many investment portfolios. Bonds provide regular interest payments and return the principal at maturity, offering a predictable income stream and lower risk compared to equities. However, bonds are subject to interest rate risk, where rising interest rates lead to declining bond prices. Understanding the duration, which measures a bond's sensitivity to interest rate changes, is essential for managing this risk. For example, a bond with a duration of 5 years will see its price decrease by approximately 5% if interest rates rise by 1%. Equities represent ownership in a company and entitle shareholders to a portion of the company's profits, usually in the form of dividends. The value of equities is influenced by factors such as corporate earnings, economic conditions, and market sentiment. Stock valuation methods, including the price-to-earnings ratio, price-to-book ratio, and discounted cash flow analysis, help investors determine whether a stock is fairly valued. For example, a company with a P/E ratio significantly higher than the industry average might be considered overvalued, indicating potential downside risk. Real estate is another popular investment asset class that offers both income and capital appreciation. Real estate investments can be made directly through property ownership or indirectly through real estate investment trusts. The performance of real estate is influenced by factors such as location, property condition, and economic trends. Investing in real estate provides diversification benefits and can act as a hedge against inflation, as property values and rental income tend to rise with inflation. Commodities, including precious metals, energy, and agricultural products, are tangible assets that can diversify an investment portfolio and provide protection against inflation and geopolitical risks. Investing in commodities can be done through direct ownership, futures contracts, or commodity-focused mutual funds and ETFs. For example, gold is often considered a safe haven asset during times of economic uncertainty, and its price tends to rise when other assets are underperforming. Alternative investments, such as private equity, hedge funds, and venture capital, offer opportunities for higher returns, but come with higher risk and less liquidity compared to traditional assets. These investments are typically accessible to accredited investors and institutions due to their complexity and regulatory requirements. For example, private equity involves investing in privately held companies, which can yield substantial returns through operational improvements and strategic exits. Understanding and applying these investment fundamentals is essential for constructing a robust investment strategy that aligns with an investor's goals, risk tolerance, and time horizon. By comprehensively analyzing risk and return, diversifying investments, strategically allocating assets, and considering external factors such as taxes and inflation, investors can make informed decisions that enhance their financial well-being. The integration of behavioral finance insights further refines investment strategies, helping investors navigate market complexities and achieve long-term success. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us. and we look forward to supporting your continued pursuit of knowledge.